Welcome to Iron Financial. We're here to help you forge a stronger portfolio. And today, we are putting ConocoPhillips right under the hammer. The company just dropped its Q4 2025 earnings, and if you just read the headlines, well, it looks like a complete disaster. But buried deep inside those numbers, there's a totally different story taking shape. So the big question is this: are we looking at dangerous cracks in the armor of an industry titan, or is management in the process of pouring a foundation of solid steel for the decade ahead? Let's get into it.
Whoa, hold on a minute. A very strong year? You've got to be kidding me. I'm looking at the screen right now, and what I see is a miss on earnings, a miss on revenue, and the stock getting smacked down almost 3% before the market even opened. The street saw these numbers and hit the sell button, simple as that. So are we supposed to believe that management isn't just trying to put some lipstick on a pig here? Because from where I'm sitting, what the company is saying and what the market is screaming are polar opposites.
And that's the exact disconnect we are here to hammer out. We're going to do it step by step. So here's how we're going to break this all down. First up, we're looking at what we call the headline fracture, those raw numbers that spooked you and every other trader out there. Then we're going to go a layer deeper, deconstructing the damage to find out what really caused the miss. After that, we pivot to forging operational strength to see what management was actually busy building behind the scenes. We'll lay out the cash flow blueprint for the future, show you how that leads directly to the shareholder payoff, and then finally, we'll give our verdict. Is ConocoPhillips a dangerous value trap, or is it a solid foundation you can build on?
All right, let's start right there with the damage report. Because when these kinds of numbers hit the news feeds, the trading algorithms and the fast money crowd, they don't sit around and debate the finer points. They react, and boy, did they react. It was fast, and it was negative. This right here is the bear case, plain and simple. It's all about the top-line metrics that drive the news, and you just can't pretend that initial shockwave didn't happen. This is the reality investors had to swallow with their morning coffee.
I mean, just look at this. You can't spin these numbers. Wall Street was expecting adjusted earnings per share to land somewhere between $1.10 and $1.18. ConocoPhillips comes in at $1.02. That's not a close call, that's a clean miss. Then you look at revenue. The expectation was over $14.1 billion. The actual number? Just over $13.8 billion. That's another miss. And the result? Pow. The stock drops 2.7% before the opening bell even rings. On the surface, this just screams failure to deliver. This is the kind of stuff that makes investors dump a stock first and ask questions later.
Okay, so the headlines are bad. The market's knee-jerk reaction was to sell. I hear you. But here at Iron Financial, we don't build portfolios based on headlines. We analyze the underlying structure. You know, any apprentice can walk by a building and see a crack in the wall, but it takes an expert to know if that's just a cosmetic flaw in the paint or if the whole foundation is about to give way. So let's grab our tools and start deconstructing what really went wrong with the company's profits.
And let's be clear, the drop was absolutely massive. This is a snapshot from their own earnings report. In the fourth quarter of 2024, their adjusted earnings were sitting pretty at over $2.4 billion. Now fast forward just 1 year to this quarter, and that number got cut almost in half, down to $1.26 billion. That's a 47% collapse in year-over-year profits. It's a huge, ugly number, and it's the reason for all the negative headlines. But the real question is why? Why did it happen?
And here's how that pain gets translated down to you, the individual shareholder. A year ago, your piece of the profit was nearly $2 a share, $1.98 to be exact. This quarter, it's just $1.02.
So you're telling me the profit-generating power of my share of the company was essentially sliced in half in 12 months. That's what really matters to the person writing the check to buy this stock. So let's get right to it. What caused this massive erosion of profit?
And that really is the billion-dollar question, isn't it? Did the actual machinery of the company break down? Did management just completely lose control of their operations? Did costs spiral out of control, or did their wells suddenly stop pumping? Because if this is an internal operational screw-up, then those cracks on the surface are a sign of a very serious problem deep inside. But if it was some external force they couldn't control, well, that's a completely different story. So which is it? Was the CEO's strong year comment just a bunch of hot air? Or is there something real going on here?
Here's your answer. This one slide explains almost the entire earnings miss. This was not an operational failure, it was a price failure. In the fourth quarter of 2024, ConocoPhillips was getting an average of $52.37 for every barrel of oil equivalent they sold. 1 year later, that price had plunged by nearly 19%, all the way down to $42.46. Just think about that.
Imagine you own a coffee shop, and the price you can charge for a cup of coffee drops by almost a fifth overnight. That is an enormous headwind to fight against, and it's something that management has virtually zero control over.
Right. So if we all agree that the plunge in commodity prices was the hurricane, then the real test of a company, the real test of its leadership, is how well they captained the ship through that hurricane. While the market was freaking out about the falling price of oil, a completely different narrative was playing out inside the company walls. Management wasn't running around in a panic. They were executing their plan. They were forging new strength, reinforcing the core of the business, and focusing like a laser on every single thing that they could control.
And that brings us right back to this quote from the CEO, Ryan Lance. See, when he said 2025 was a very strong year, he wasn't looking at the stock ticker on his phone. He was looking at his internal operational dashboard. He was measuring his team's performance against the goals they set for themselves, not against the wild, unpredictable mood swings of the global commodity markets. Let's go to the next slide and see the actual proof he was looking at.
This right here, this is the bull case in a single slide. While prices were in a free fall, look at what ConocoPhillips was doing. This is the heavy lifting. They beat their own targets on capital spending, on operating costs, and on production. They actually grew production by 2.5%. That pro forma basis just means they adjusted the numbers for the Marathon oil deal to give you a true apples-to-apples comparison. They swallowed that huge acquisition and managed to double the expected cost savings to over $1 billion. They sold off assets they didn't need, used that cash to slash their net debt by $2 billion, and on top of it all, their engineers found a way to drill for oil over 15% more efficiently. I mean, each one of these bullet points is a huge operational win. You put them all together and it paints a picture of a company that is absolutely firing on all cylinders.
Okay, fine. I'll give you that. That's some impressive execution. But is this stuff that's going to last? Or are these just a bunch of one-time tricks to make a really bad year look a little bit better on paper?
That is the key question. And the answer is yes, this is absolutely sustainable. Because these wins were not a string of lucky breaks. They are all individual pieces of a very deliberate multi-year blueprint. The goal here isn't just to weather a storm, it's to emerge from it leaner, tougher, and specifically engineered to gush free cash flow no matter what the market is doing. This is where the company stops playing defense and starts playing offense.
And this slide, which we pulled straight from their investor deck, is basically the architectural drawing of their plan. It's incredibly simple and incredibly powerful. On the top left, you see capital spending going down. On the bottom left, you see operating costs going down. To be specific, they are chopping about $600 million from capital expenses and another $400 million from operating costs. You add those together, that's a $1 billion reduction in the cash going out the door in 2026, and the direct result of that, which you see on the right, is a planned $1 billion increase in free cash flow for the year. They are literally building a more efficient cash-generating machine.
Okay, $1 billion extra in 2026. That sounds nice, but come on, we've all seen rosy one-year projections from companies that just disappear into thin air. Is this a one-and-done fix? Is it just a temporary patch on a foundation that's still cracking? I want to see the whole construction schedule. Is this a real, concrete plan, or is it just another pretty promise on a PowerPoint slide?
It's a concrete plan, and here is the timeline to prove it. That extra billion in free cash flow for 2026, that's not the finish line. That's just the starting gun. Management is projecting another $1 billion increase in 2027, and then another $1 billion on top of that in 2028. And then comes the real game changer. In 2029, their massive Willow project up in Alaska is scheduled to come online, and that's expected to add another $4 billion in free cash flow, all by itself. So no, this isn't a patch. This is a planned multi-year cash flow explosion designed to generate an extra $7 billion a year by the end of the decade.
So what does a $7 billion cash flow machine mean for you, the actual investor? All of this hard work, all this cost-cutting, all this meticulous long-term planning, it all funnels down to one single purpose: to put more cold, hard cash directly into the pockets of the people who own the company. So let's look at exactly how ConocoPhillips turns this operational muscle into a direct payoff for shareholders. And it all starts with this one simple number: 45%. ConocoPhillips has a clear, disciplined, and publicly stated commitment to return 45% of its cash from operations. That's the raw cash the business generates before they spend on big new projects, directly back to shareholders. This isn't some vague hope. It's a core part of their contract with investors. It's a policy that forces management to be disciplined with every dollar and guarantees that shareholders get a huge piece of the pot.
And here is precisely how they make good on that 45% promise. First, with a steadily growing base dividend. And they're not just aiming for average growth, their goal is to be in the top 25% of the entire S&P 500. Second, they do it with aggressive share buybacks. In 2025 alone, they sent $9 billion back to shareholders, and $5 billion of that was used to buy back their own stock. By taking shares off the market, they make every remaining share that much more valuable. And they do all of this from a position of incredible strength, ending the year with $7.4 billion of cash just sitting on the balance sheet.
But wait a second. 45% is a giant commitment. A top-tier dividend is an expensive promise to keep. Is it really durable? We just saw what a 19% price drop did to their profits. So what happens if oil prices crater again? What happens if they fall back into the low 40s or, heaven forbid, the 30s? Is this entire shareholder return promise just going to shatter into a million pieces?
And that's where this concept of the free cash flow break-even becomes the single most important number in this entire explainer. This is the price of oil the company needs just to cover all its spending and pay its dividend. And because of all that heavy lifting and efficiency we just talked about, ConocoPhillips projects that this break-even price is going to fall all the way into the low 30s per barrel by the end of the decade. They are building a business that is designed to flood shareholders with cash, even in a world of low oil prices. That isn't a foundation made of sand, that is a foundation of steel.
Okay, so we've laid out the two totally different stories here. On one hand, you have the story of the headline fracture, the earnings miss, and the stock getting punished. And on the other hand, you have the story of deep operational execution, a long-term cash flow blueprint, and a rock-solid plan to reward shareholders. It's time to put them side by side and deliver our verdict.
Look, the bear case is simple. It's based on what you can see with your own two eyes right now. The earnings miss is a fact. The revenue miss is a fact. The stock dropped for a good reason. And let's not kid ourselves, this company's fortunes are still chained to the crazy swings of commodity prices. But the bull case is built on what management is meticulously engineering for tomorrow. They are showing incredible discipline with their costs and their capital. Yeah, but huge future projects like Willow always carry a risk they won't get done on time or on budget. And the simple fact is, profits were down and they were down big compared to last year. True, but they have laid out a crystal clear, multi-year plan for enormous free cash flow growth. That cash is already earmarked for shareholders through a very robust return policy, and all the while the company's break-even price is dropping lower and lower, making that entire framework more and more durable with each passing year. You're betting on what the CEO calls the highest quality asset base in the entire industry.
So here is our final verdict. The question you should be asking yourself isn't a simple buy or sell. The real question is about your own investment horizon and what you choose to focus on. If your focus is on the day-to-day noise, the headlines, and the short-term numbers, then yes, the cracks are there, they're obvious, and they are concerning. But if you're willing to look past that surface, if you're willing to analyze the structural work that's being done, the cost-cutting, the efficiency gains, the cash flow engineering, then you see a company that isn't just patching cracks. It's a company that is systematically pouring a much deeper, much more durable foundation for the future.
The choice, as it always is yours to make. Are you investing in the snapshot of today, or are you investing in the blueprint for tomorrow? That's the decision every single investor needs to make for themselves. Thanks for joining us here at Iron Financial, where we cut through the market noise to help you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.